Well, hi everyone. Buffett and Beyond Research brings you our Saturday stock market recap, and this is January 11th, 2025. And let's look at what's been going on this week. Well, with the market, it had its second down week in a row and has two choices. Yeah, either up or down. But with yesterday's almost 700-point drop in the Dow, we are sitting on a triple bottom. We're going to see that chart in a second. And this coming week, either that area of support is broken or we begin another part of the downtrend. And folks, it's all about interest rates, because the interest rates, or I should say the bond market, is much, much bigger than the stock market. And you would think when interest rates go up, it would be good for some areas because people would buy more bonds. But they take their money from stocks and put them into bonds, and that's why the stock market goes down. Our weekly stock analysis video: what stock is a growth stock but yet went up in 2022 when the S&P was down 19.6% and the NASDAQ was down 34%? Yes, it's our old friend BJ's Wholesale, which is in our growth portfolio, folks. In our ETF video, we showed you why we hedged our chess portfolio on Thursday. And too bad I didn't hedge my own personal portfolio until Friday. So let's take a look at what some trader friends of mine told me on Thursday to look for, and why we hedged our test portfolio, which is not it is my personal test portfolio, but it's not my personal portfolio. So did great on the test portfolio, and I should have done it on my own personal portfolio, folks. But we'll take a look. So don't forget to watch that ETF video that comes along with these other videos that we send out every Saturday. All right, there's two things I want to bring up before we go on. First one is spam. A lot of emails are going to spam, and the internet providers are getting so annoying that even emails I sent to myself in the form of reminder notes go to my own spam box, and I'm sitting right here looking at my phone. And as I hear market news throughout the day, I send reminders to myself, and at least 2 a day go to spam. So my own stuff to me is going to spam. So many of your emails also go to spam, which I do check often. And some of the email providers just plain block your emails. And I tried to get in contact with you, but all the emails are starting to get blocked, even from my personal email. Now, most of our emails, like this one, is going to come through Constant Contact, and some of the email providers are just blocking anything that's sent out in bulk emails. And folks, that's going to cut down a lot of emails. The problem is you folks pay for a lot of those emails that are not getting through. So if you send me an email and I don't respond in a few days, then please resend it. It doesn't bother me that I get 2 of the same questions from you folks, because, folks, electronic heaven is full of lost emails, believe me, and you all know that. Now, some trading ideas come late in the day, so those of you who want to trade, you may see many times the market doesn't give itself away until the last half hour of the day, and I try to send something out, and of course you get it, 30 seconds before the market closes, and you can't react on it. But usually these are hedges that can be put on the next day. But of course, you want to read the morning daily letter that we send out before you put anything on. So we'll see on Monday if we want to put on those hedges, and I'll send out a little blurb on Monday morning, and we'll see how the market opens, or maybe it won't give itself away until afternoon or noontime or somewhere in there. But usually these hedges can be put on the next day, and this is why, if you're using hedges, I don't know why a lot of you don't just put the puts on about 12 to 15% below the market. And if you're not sitting at your computer and you don't want to pay for that, well, use a money manager, some of the money managers that we recommend, because then they'll not only do the covered option writing for you, and there are only a few. We only need to do a few a quarter, and the money manager can usually pay for their own fees along with paying for those put options. So then you don't have to worry about it. And that's what we did way back in 1987, and that was on Black Monday. when the market fell itself 22% and nobody could get through their brokers to sell. Nasty, nasty day. But we had those puts on, and that's when we first came upon them, because that was a strategy that I used at that particular time, and boy, it worked nice. And as the market kept going down, we kept putting another put on. So that was all done automatically by, I shouldn't say automatically, that was done by us because we knew what the strategy was. But most of you who didn't use puts and got caught in that 22-day decline, 22% decline in the Dow, you didn't get your money back for 2.5 years. And folks, those of the people that had those puts on were able to sell the puts pretty much near the bottom. When, remember, Alan Greenspan was chair of the Federal Reserve at that time, and he put out a statement that he was backing all the specialists on the street and said, you buy stocks tomorrow morning when the market opens, and the Federal Reserve told the banks to back all the specialists so they could buy. And that put a stop on the market. And it was tumultuous for a couple of days. But that's when we started getting rid of our puts and taking that money and buying more stocks with it at that bottom. That was a beautiful, beautiful move, and set people up for the people I was working for, set them up for the next 10 years. It was a good thing to have, and you could sleep at night. So what I'm saying is that some of you who said, well, okay, I don't want to do that, I don't understand covered option writing, and you don't give me enough covered option writing to do. Well, we do some spreads, we do the covered option writing, and I use it in my portfolio so that I don't have to worry about if the market goes awry in any one time. And that's what happened in 1987. And I went through it in one of the newsletters this past week or the week before to tell you all and told you all about it. But folks, it's nice to have, and you sell a couple of covered calls during the quarter and let a money manager do it for you so you don't have to worry about it. My gosh, for 1.5% that the money manager charges, it is nothing compared to some of those returns that we get. In fact, to all the returns that we get, 1.5% is nothing. Usually the money manager makes enough to not only pay for the puts, but to also pay for their own fees through covered option writing. So folks, think about that and think hard about it, because I do it myself. I am not a money manager, but I'm the one who handles my own portfolio, and that's what I do. And then I don't have to worry about the very short-term fluctuations of the market. So just a few things I wanted to tell you in today's letter, which is usually very short and shorter than this page I just talked to you about. All right, let's look at the market, and here we are at the bottom of that bottom volatility band. And folks, you can see we closed right about a little bit below where we closed here, and down here we still have this indicator pointing down. That is not a good sign. So Monday is going to be a very, very tough day, Tuesday probably, and the banks start reporting. Tuesday the producer price index comes out, and Wednesday the consumer price index comes out. So the market is going to be looking at that. If they come in strong and the Fed feels that inflation is rearing its ugly head a little bit or is not receding, it might just say something like, we're not going to lower interest rates this year. And that is what could hurt the market. And that's what we're looking at here, folks. Right now, we're looking at this area a little over 5,800 on the S&P 500. Not a good area right here. We don't like these declining tops. See these declining tops? Yeah. And this indicator down here continues down into oversold territory. That's one good thing. At least we're in oversold territory. Let's go to the Dow Industrials and let us look at this indicator up here, which is stochastics. And I mentioned declining tops. And look at that. And this is, in our ETF letter, we talk about this indicator here turned over on Thursday. And I didn't see that, but one of my trader friends I was on the phone with saw it, and he said, hey, you better watch out. And that was right around Wednesday that I was on the phone to him, and he said, this thing is starting to turn, and it was down in here. So we bought puts in that test portfolio. Yeah, and that was a good move, because between that and then Friday, which was a horrible day, it was nasty. And look, we're sitting down here almost in nowhere land on the Dow. Well, it may be this line down here at 41,750, which is probably another 200 points down. So we'll probably see that Monday morning, at least a test of this area in here. And also on the Dow, yeah, you see we are very oversold on the Dow. One good thing on Friday, the volume was the Dow volume, this red line down here, red vertical line. It was lighter than it was on Wednesday. So that was a kind of a happy sign, if you want to call any of Friday happy about anything there. So yeah, closed down almost 700 points, actually 696 points. You can see that up here. So we have to be very, very careful on Monday, because we think some lower points will be tested, but boy, oh boy, it could bounce right up. We don't know. It all depends what interest rates are doing on Monday, and the bond market dictates what the stock market is going to do. So if the bonds are going down because interest rates are going up, the stock market will go down. And that's what's happening right now. And portfolio protection, this is what we were talking about. We have the January puts, we have the February puts, we have the March puts. This is about $150,000 portfolio right now when we have those 500 puts. And we're sitting here. If you have this kind of protection, you say, I don't care about the daily fluctuations. I'd rather see the fluctuations be on the upside than the downside. But I have this protection there. I don't have to worry about the daily swings in that. And don't forget, these puts are starting to gain in value as the market goes down. That's what's good about the puts. And we're also using, one of you suggested, I guess it was a couple of years ago, how about the puts on the QQQs? And folks, that's what we're using also. Not only the SPY puts, which are the S&P 500, but we're using the QQQ puts, or we use calls on the SQQQs. Remember, the SQQQs go in the opposite direction of the NASDAQ 100, which are the QQQs. And so you could buy calls on one or puts on the other, whichever becomes less expensive. And that's what we're doing. We like to use the SQQQs, and we use calls on the SQQQs because if the market goes down, the SQQQs go up. So we use calls on those. Yeah, it's hard to get it through your head the first couple of times you hear it, or the first couple of years you hear it. It's a little complicated, but that's what we do. And folks, that's another reason why you need a money manager, because even if a signal comes in the last half hour of the day, that call goes out to those money managers from our office, and we say, hey, this is what we see here. They're at their computers. They press a button, and all their portfolios that are using protection all go off at the same time and the same price. And even if it comes in 2 minutes before, they can push the button, and that's the end of the story. You don't have to worry about it. So that's why money management comes in. And as I said, for 1.5%, really, that's nothing compared to the returns that we've been getting over the years, especially last year with our QQQ portfolio up 97%. In 2020, that was 2023. In 2024, what was it? Oh, it was up only 47%. So what are we talking about, 1.5%? Don't be penny wise and pound foolish on this stuff, because this is your wealth that you're going to count on as you retire, or are counting on it right now. So, folks, let's forget about this past week. It was nasty. Let's forget about the week before, too, because it wasn't so nice either. So go out, enjoy yourself. take a walk on the beach, walk on the frozen golf course if you're up north, or go play in the snow, you go ice skating, do anything, take your mind off the market. Or you could be down here on the beach in Florida at sunrise, and if you want to be able to walk on this beach that Jimmy Buffett once walked on, you've got to learn how to invest even better than Warren Buffett does now. So folks, take it easy, be safe. We'll see you back here in a couple of days.